welcome everyone to SSP live stream. It is Monday, May 6th, 2024. Welcome, glad you're here. Thanks so much for joining, and happy to be here with you. So today's going to be a very positive conversation around what is going on. I'll get to that in a minute with the Federal Reserve, because they did a huge about face last week, and not only with their interest rate policies, but also with Treasury bonds. And we'll talk about that because it's so powerful and critical to this ongoing market. But first, I've got Apple on the screen here. Apple's earnings came out. It shot the stock higher, and just found something very interesting with them. You know, they announced a stock buyback, and it's $110 billion of their common stock. Now, I want to put that in perspective because the value of this buyback is greater than the market capitalization of 419 companies in the S&P 500. Roughly 84% of the market cap, 84% of the market cap of those companies, the buyback is greater than that of the S&P 500. This buyback is larger than the market cap of Boeing, Starbucks, PayPal, Northrop Grumman, Ford, and eBay, some of big company names that you're already familiar with and know. It's great for being an investor because buybacks increase our percentage stake in the company. It's a great way to return capital to shareholders in a tax-free way. So I wanted to bring that to your attention. If you're interested in Apple stock, this would be the time to consider investing in it, because you will be able to, let me just bring my screen in a little more, you'll be able to take advantage of that massive buyback that was just announced. All right, so very positive thing. So a lot is happening in this market, and it's happening very quickly. You've probably felt that as an investor. You probably have seen that in your investments. You might have been in some stocks that were underwater temporarily. Great companies like Netflix, Meta. I'm right there with you that even though their earnings were spectacular, the stocks pulled back 10 to 15%. And it's been nothing short of an incredible buying opportunity. But I can definitively say that now because of this situation that happened last week. And I want to talk about this. This is key and paramount to our stock market. It's important because of this situation. Business insolvencies spike in the first quarter. Consumer insolvencies also rise. This is up in Canada. Just talking about, I'll put this link in the show notes today, businesses insolvencies surged 87.2% year over year in the first quarter of 2024, while consumer insolvencies rose 14%. So I think what we're having, this situation of major headwind for businesses and investors and consumers because of inflation and high interest rates. Those have been the double threat to growth in this economy. And with this, the governments around the world know the importance of propping up this equity market. They've got to do something to reduce fear, reduce panic, and create some solvency in a world that is debt-based and insolvent. So I think this is what they've decided to do. They're going to start buying back their bonds, and this has happened before, and I'll talk about that in a moment. But this is the key. The liquidity metrics, defined as the ease with which trades can be carried out are still near the worst level since the market mayhem at the onset of the pandemic. So we know, and that makes perfect sense because liquidity has dried up because, just as I mentioned, interest rates have gone up and there's been what's called a restrictive, constrictive financial environment. Lending isn't easing up. People aren't able to borrow money. And in order to keep solvency, keep the government solvent, they've done nothing but issue huge amounts, billions and billions of dollars of treasury bills, bonds, and notes. Bills, notes, and bonds in that order. Bills are short term, notes are intermediate term, 10 years or greater, longer, and then bonds are long term. So the Bloomberg U.S. Government Securities Liquidity Index, a measure of deviations in yields from a fair value model, remains near the highest level since March. Here's what happened in March. That's when the banking crisis triggered near unprecedented volatility, with some yields recording their largest swings in 40 years. Really, in March, that's when the 10-year Treasury note spiked. The yield spiked, and as you know, it's an inverse relationship. As yields go up, values drop. So with the spike in rates, there was this huge plummet of bonds in institutional investors' portfolios. And those who are what buys a significant amount of bonds, as well as other countries in the world. So therefore, liquidity was significantly compromised, JP Morgan Chase and Co. strategists told clients in mid-March, as trading in Treasury surged to a record $1.5 trillion on one day. What's causing the problem? Steep losses for bonds caused by faster inflation and interest rate increases by the Fed. So they're creating the exact problem that we find ourselves in today. You see, it's the same. The Federal Reserve, as you know, is not a federal institution. It's a private corporation. So it has nothing to do with the Federal Reserve. Even though it says Federal Reserve, that is not the case. It's a private corporation that is causing mayhem and havoc over here and then coming in, swooping in and saving the day. Hey, but at least they stepped up. That's what's going on. So they caused the problem. What's the Fed doing? It's still unwinding its treasuries from its balance sheet, a process that they started in 2022. In fact, they've increased the pace, $60 billion a month in September. That was last September. As the largest buyer of government debt, its decision to step back means that dealers will be expected to absorb the additional supply that's returning to the market. I think the market is going to be able to absorb that supply. But here's what's important. What is the Treasury doing? It has decided to start conducting here's the key, regular buyback operations for liquidity support and quote-unquote cash management, which is money used to pay the government's bills and maturing liabilities. It will buy back the older securities and replace them with larger current issues. So the older securities means lower rates, higher prices. It's going to absorb those losses, but in return, it's going to issue more bonds, bills, and notes, a greater amount at higher interest rates. So they're hoping this is going to help overall. While the department is still working out the details, it said the program will be conducted in a regular and predictable manner, initially sized conservatively and not intended to meaningfully change the overall maturity profile of marketable debt outstanding. Has it done this before? Yes, it has. It did this between March 2000 and April 2002. Now, if you were in the markets during that time, that was the exact time that coincided with the decline in technology stocks. The NASDAQ The end of 99, the NASDAQ was growing like every day, up and up and up in value. And we were even wondering, sorry, Norman, I kicked my little cat here. We were even wondering, can the NASDAQ surpass the Dow Jones Industrial Average? Like, we didn't know. Of course, it didn't, and it's not even anywhere close right now. But the Treasury had to step in. So how would it work? They're still kind of working this out, but the Treasury Borrowing Advisory Committee, a group that includes dealers, investors, and other stakeholders, said in May that a proposed sizing of up to $240 billion per year should be meaningful to market participants. So this is interesting too. What does the Treasury hope to achieve with these operations? One of the main goals of the new buyback is to support liquidity. And we know that because there is none in this market. This is key. So I think this is very positive in terms of what the Fed is doing. It's helpful to the market. It's going to allow for more liquidity to come into the market. And it's interesting because typically higher interest rates do remove liquidity in the market. Higher interest rates create a restrictive lending environment. So this is almost like the Fed, to some level, is admitting the challenge that they created, and in return is taking a little bit of responsibility because they're trying to fix it. This could also be an indication that they will not raise rates this year. That is what is really fueling the market right now, is the hope that interest rates don't go up. So we have an incredible, incredible time right now as an investor. Everything across the board is up. Just phenomenal returns late last week after this was announced, and early this week. So I think we're going to continue to see growth in the equity markets. I think the Fed is really stepping in a very positive way to help that situation. And I wanted to bring to your attention, there's so many, thank you, by the way, all the new supporters on our platform. I just wanted to show you under our main menu, winning stocks. Check out our success recipes. These are what we put together, is a recipe for inside of our software, what steps to take based on your investing goal. So if you're looking for income or lightning fast growth, 30 days or less, just check out these different steps. They'll walk you through, if you're looking to build wealth, there's different strategies that can be applied to different goals, investment goals that you have. And we've put here a little recipe card, if you will, in terms of how to find that within our software. Hope this was helpful. Have a fantastic week, and I will see you next Monday. Bye for now.